edged slightly lower on gold, sorry, edged slightly lower on, yes, a slight dollar strength, but of course ahead of the Fed. It posted highs close to 2200 a few Fridays ago on those hot inflation concerns. But you can just see I've just highlighted this and brought up the gold chart really because we're still just above that previous spike high at 2148. Tracking sideways, as you can see, narrow ranges, which really means the longer we track sideways in narrow ranges, range contraction, the bigger range expansion will be at some point. So 2148, strong support. You can see I've got a couple of fib levels in here. Short-term fib level at 2145. That's that minor fib level to 23.6 of this move from the February lows. At 1984. Otherwise, the long-term fib levels are much lower down. So interesting, that 2145, 2148 region of support. If we do lose that, then we drop probably potentially quite sharply, having traded in narrow ranges. Before this, just to double check, just checking the microphone was on. Yes, welcome to this edition of Expert Market Analysis. Of course, we think the market is generally driven by themes, which markets relate to and which grow in importance through time. We'll look, as I said, during this webinar at how markets are shaping up, which we're just going through now. We'll then get to the Bank of Japan meeting and dollar yen. We'll look at the RBA and Aussie dollar before then looking at some previous data from last week, the US CPI data, UK jobs data, and then actually as well UK CPI data we had this morning. We'll then get into a preview of the Fed meeting, of course, tonight, the Bank of England meeting tomorrow. We'll look at cable, we'll look at the DXY dollar index chart before then as well, hopefully having time to look at the SNB, the Swiss National Bank, and dollar Swiss. Just interesting potential meeting there, 30% or so chance of a rate cut there, and then hopefully we'll have time to look at euro dollar and some of the data coming out there. The PMI data out tomorrow could be quite interesting for markets. Okay, yeah, we've just got this gold price here, as I said. Interesting ahead of the Fed for sure, and the more we track sideways, the bigger the range expansion should be potentially going forward. Otherwise, in equities, if I just pull up a couple of charts, of course, we hit record highs, as I said, yesterday, 51.80, the high, but 51.78, that record high close. Yes, just continuing with this sort of bull channel, higher series of higher highs, higher lows. We're not overbought, so just interesting really how we're moving higher. Nvidia has been grabbing the headlines again after its GTC event. Was up just around 1% amid that launch of its new Blackwell AI chip, an expanding stack of its AI customers. There weren't really any major new headlines, I don't think, any major new, surprises really. So not a great deal amount of exuberance. I know that some analysts have been raising their price targets. So Goldman Sachs raised their price target to $1,000 from around $870, I think, the previous price target. And another investment bank as well this morning just actually raised their price target to above $1,000 now. So yeah, still strong conviction on the stock with its sort of plethora of major, huge AI customers, and the fact that most analysts think it will continue to be the preeminent stock for the AI enablers, if you like, passing on, of course, their tech savvy, their tech products to the wider global customer base, I guess. Thursday, that's notable in terms of earnings out of the US. Actually, we have Nike, we have FedEx, we have Lululemon, and we have Accenture. We also get Chinese earnings actually from Xiaomi, PDD, 1.10. So that's really equity news. Single stock news, just to mention big news earlier in the week, we had talks between Apple and Google to let Google's generative AI system Gemini power AI features on the iPhone, and that helped Google, I know, the start of the week. Okay, yeah, stocks, ascending bull channel still, 5180 the high. Looks like it keeps on going, really. Interesting Nasdaq, sort of that ascending bull channel there. We've drawn in it so you can see it, and we just sort of tapped it yesterday, tapped it last Friday, but then moved higher. So we're still in that channel. Support probably from last week's low at 17,764, and then the high obviously at 18,416. That blue line there is the 50-day moving average. That's at 17,622. As for the Dow, yep, still sort of a slightly more shallow bull channel from that previous one to finish off the end of last year. Record high 39,282. We have that there. Strong day yesterday, finished near the highs, interestingly enough. High at 39,122, finished at 39,110, and as I say, the all-time high 39,282, but it looks like it was a record high close. Again, support, probably the 50-day moving average looks good to tally with that March low, the 50-day moving average at 38,451. Okay, if we now we'll go to dollar yen actually, and look at this interesting move, obviously after the Bank of Japan's decision to end basically their historic policy mix. They raised rates from negative 0.1% to a target range between 0 and 0.1%. That was the first hike since 2007 and ended an 8-year experiment of sub-zero rates. At the same time, it officially terminated yield curve control. But the Bank of Japan does promise to continue its bond purchasing program at broadly the same pace and make, it says, nimble responses in case of rapid rate increases. That really is just a calm bond market, turbulence bond market volatility because of this ending of ZIRP, basically NIRP, which is negative interest rate policy. We're now at ZIRP, of course, 0 or just above that. Yeah, so a decision still to buy bonds, as I say, to sort of quell volatility, and that job has been done pretty well, really. Many expecting this decision would spark volatility potentially in other areas of the market, but it hasn't done so yet. The decision was taken with a 7-2 majority vote, the opposing members asking really for more time to see the wage outcome in smaller businesses. At the same time, central bank does also discontinue its ETF and J REIT buying as well. We can see dollar yen moved higher, sharply higher. The yen sold off strongly, has done against other currencies as well. On these headlines that the Bank of Japan would keep accommodative policy for a while. They stressed that this still accommodative policy stance won't go anywhere anytime soon, and indeed the lack of guidance means the hike probably won't be followed by continued follow-through action and more policy normalization. And in fact, Governor Ueda and other policymakers have hinted that long before yesterday morning. It seems likely the Bank of Japan will probably move very cautiously then from here, not really seeing a steep hiking cycle ahead. And then the Bank of Japan will assess the situation meeting by meeting. and really dependent on these wage hikes, which we have seen, of course, with last week's Rengo wage deal at 5.3% or so, that biggest deal since 1991, biggest increase in wages. And we do get then the second tally on Friday, third tally the following Friday, to do with really the SME, smaller business, medium enterprises segment, which may potentially have a bearing on what the Bank of Japan do going forward. But the problem for the yen really, aside from obviously this lack of more hawkish guidance, really dovish guidance from the Bank of Japan, then with around 30 basis points, I think, was priced in before the meeting for after that 10 basis points hike, so another 20 basis points priced in for this year, I think, and that has come back, of course, with their lack of guidance, as I say. But the problem as well for the yen, volatility does remain exceptionally low, so the carry trade, so that's when investors borrow in the yen using lower interest rates and then buy higher yielding assets in other countries to take advantage basically of rate differentials. That trade is still exceptionally popular. So that is an issue still for the yen. We are now pushed higher, strongly higher, of course. We've broken that previous February high, the year-to-date high at 150.88. So we're now heading towards 151.94. That is the October 2022. You can see 2022 pop higher. Before then, the Japanese authorities intervened, spending about $70 billion intervening in the currency, and then the major obviously fell back. We also saw that in October last year, where we got up to these levels around 151.90, 80, yeah, 90 actually, and then we just fell back as well. So we're getting close to that. So watch now on the wires for any jawboning, as I mentioned, verbal intervention by Japanese authorities, by the Ministry of Finance. There are locals in Tokyo, I understand, who kind of think that the Bank of Japan will not intervene to sell dollar yen until sort of higher, sort of mid 150s. So that is an interesting thought. Remember that dollar yen, as I've sort of mentioned, is a yield differential play. So what is critical here then is that a lower dollar yen will have to be led from the dollar side. So with rates, but with rates, or because Fed rates are at 5.25%, 5.5%, a BOJ hike obviously from -1 to 0 to 0.1% really doesn't close that yield gap in any significant way. And even considering the forward pricing of Bank of Japan, I think there's still, well, less than 30 basis points now for this year, but less than 40 through over the next 2 years. That is very little additional tightening, very modest, really, policy action. And that all means then the Fed needs to do the bulk of its work, or the bulk of the work, in closing the yield gap between treasuries and Japanese government bond yields. And really then, that, as I said, that fate of the yen remains in the hands of the Fed rather than probably Governor Ueda at the moment. Okay, that's dollar yen and the Bank of Japan. If we will go to Aussie dollar now, just checking out the RBA. They, as anticipated really by markets and consensus, kept policy rates unchanged at 4.35%, but there was a slight twist. Previously, the RBA had explicitly maintained the door open for further hikes, but now they simply state that the board is not ruling anything in or out, which the markets really took as a more dovish signal. There are encouraging signs on inflation moderating, but the economic outlook remains uncertain. Central forecasts are for inflation to return to the target range in 2025, that's 2 to 3%, and to then the midpoint in 2026. Household consumption, I think growth, that remains particularly weak, but real incomes really expected to rise and support consumption potentially later in the year. The labour market, well, that continues to ease gradually, although it does remain tight, and tighter than is consistent with really sustained full employment and inflation at target. So markets, they're pricing now the first rate cut around the September meeting, and then we did see a fall back in Aussie dollar. We have been sort of holding just around the sort of 200-day, that black line moving average, and the blue line, the 50-day moving average, that they're around sort of 65.56, 65.58. You can see just fallen now below there, and potentially now may get some support from this major long-term fib level around 65. Obviously a psychological round number as well. That's the fib level of the Q4 rally. So around 65, and then obviously the year-to-date lows at 64.42 from mid-Feb. So a couple of levels there to watch out for, with the Fed obviously ahead. Okay, just moving on to data points. Just probably want to review US inflation data very quickly. If I just show you a review, which you can see here nicely, these are the main numbers from last week. So CPI, I think it's worth looking at, obviously with the Fed in mind, was hotter than expected. The core rose 0.4% month on month, so that was above the 0.3% consensus, matching the top end really of analyst forecasts. And the year on year, then that rose 3.8%. Easing from 3.9, but more than the forecast 3.7. As for the headline numbers, month on month, that rose 0.4. That was expected, but above the previous 0.3. Year on year rose to 3.2%, above the expected and the previous 3.1%. Interestingly as well, the annualized measures, they're getting a lot of focus. So the core CPI 3-month annualized, that ticked up to 4.1% from 3.9, and the 6-month rose from 3.5 to 3.8%. So the main concern really is around the hot January report really continuing into February, kind of dismissing those arguments that seasonality concerns are less led to that one-off hot print in January. Although that said, the rise in shelter and gasoline prices, that contributed, as I've said here, over 60% of the monthly increase. So kind of suggests that the high price rises are largely concentrated in those two main areas. And excluding shelter then, on both a 6-month annualized and annual basis, actually inflation is consistent with the FOMC's 2% inflation target. So kind of mixed picture really, if you look sort of slightly deeper into the detail. Also, there's plenty of data before the May and June Fed meetings really to help shape expectations. Excuse me, there's 3 more CPI reports in April, May, and June, middle of the month pretty much, and there's also 3 PCE data reports as well. That's the favored inflation measure for the Fed because it just picks up a wider basket of prices. The next one I should note is next Friday, March 29th, and then pretty much the end of April, end of May. And we also have 3 non-farm payroll reports, of course, on the first Friday of each month in April, May, and June. So yes, just to take note of that, we just got a couple of charts. You can see we have been falling, but just now being held up really around the 3% mark for the headline CPI data. That's now the 3rd upside surprise in a row, and we're just stuck, as I said, around that 3% level now for headline. I'll just put in the PCE here though for some perspective with the CPI. You can see that's still falling, although I do note that next week's report, the March 29 report, I think the monthly is forecast to tick up to around 0.4%, which is a concern and probably giving a bid to Treasuries yields, seeing Treasuries selling, and also a bid to underpinning support really for the dollar. We also had PPI data, so input prices really last week. They gave a big boost to the dollar because they surged way beyond expectations, 0.6 month on month versus 0.3 and 1.6 year on year versus 1.2 expected. So yes, interesting data points from last week. Okay, if we just get to the Fed now. We've got a preview here with all the sort of key numbers. Really no changes, of course, expected to policy. All focus really will be on the new economic projections and dot plot. Rate cut bets have swung sharply this year, really amid some sort of mixed signals on the strength of the two Fed mandates, employment and price stability. So the labour market is cooling down, but still relatively solid. Inflation, as we've seen, cooling down, but slightly sticky. And so that means for the Fed, although it has so far avoided the trap of pre-committing to a rate cut, an easing bias has still been seen. And quite recently, Chair Powell told lawmakers, in fact, last week, that they're not far from being confident that inflation is moving sustainably towards 2%. And his readiness really to cut is likely the reason why markets react more to soft data than upbeat ones. That said, however, the Fed's projected rate cuts are based on the expectation that inflation remains in a downward trajectory despite that slowdown in the disinflation process. This in turn, of course, then turns that spotlight on the updated dot plot, and that will be the focal point of the meeting. There is a strong possibility, I don't think it's consensus yet, but the median projection for 2024 for the interest rate dot plot will be revised from the December's 3 25 basis point rate cuts to just 2. I think we only need 2 FOMC members to change their viewpoint, and that would move, as I said, from 75 basis points to 50 basis points of rate cuts for this year. And even if the median projection is left unrevised, if more participants potentially see the Fed funds rate either at 4.75% or higher, that would also reflect a hawkish tilt. I've got it pretty much in here then. We've got the inflation numbers, that solid NFP, although there were downward revisions, and then pricing at the moment. Of course, the press conference will be key, Chair Powell's press conference really, and he might potentially, if we do see that sort of reduction in the number of rate cuts for next year, this year, sorry, or potentially a change to the longer term neutral rate from 2.5%. There is speculation it could possibly go higher. I'm not sure potentially about that really, but yes, Powell in the press conference might strike a more balanced tone potentially, and that then could possibly limit any sell-offs in stocks or other risk assets. So there is a lot to contend with, especially with the dot plot and then the summary of economic projections as well. We are expecting to see upward revisions to growth and inflation, so it's just potentially where or how high those are, and then obviously around the dot plot 2024 and beyond as well. Most likely, though, probably we think is that Powell, he'll stress just data dependence. The Fed is cautious. The Fed can be patient. They want to see more data, more evidence, have more confidence, really, that the 2% target is near. Of course, he has said previously they don't have to be at 2%, just on that path towards it. And really progress on inflation in the months ahead potentially should look better with more data due, as I've mentioned. So yes, at the moment for pricing, markets have realigned, and I can see I've just got a chart in here showing you that around the 75 basis point mark for rate cuts for this year. That is where markets currently see as well. They have been, just to remember, at the start of the year had around double that, about over 150 basis points of rate cuts seen for this year. Now that's down to 75. It has oscillated, yo-yoed up to 90 only a few weeks ago, now back to 75 with that stronger CPI data. And we have around a 64% chance, I put here, of a first rate cut in June. So yes, potentially that's has been lower actually at the start of this week, but that was well, again, if you remember, we were due to have a rate cut at this meeting, at the March meeting, if you cast your minds back to the start of the year. So a lot of change and potentially still more to come, and all that focus, a lot of focus on the dot plot and then those economic projections. As well as, I should stress, Powell's tone and what he says. Potentially, I think consensus really kind of not looking for too many more changes, really, just that possible 75 to 50 basis point sort of move for rate cuts for this year. If we just look at the dollar index, which is here, you can just see a nice few consecutive days of gains, really interesting ahead of the Fed, of course. We have now moved above that black line, the 200-day moving average, that's at 103.69, and also the 50-day moving average at 103.63. So upside here, resistance probably at this swing high, start of May high, 104.29. And then if we do break that, then we get up to these highs from mid-Feb around just below 105, 104.97 and 104.96. Interesting, really. Yeah, as I say, this move higher, consecutive days of gains ahead of the major risk event, of course, being the Fed. Okay, we also have a Bank of England meeting. If I just go to a chart, I probably want to show you. I've shown you the alignment, if you like. Yeah, just the CPI chart, which we talked about, that CPI data. Didn't we? Although, no, I'm not sure I did. So I just mentioned that before looking at the Bank of England, and also the labour market data actually from last week. So that was cooling slightly, so marginally dovish for the Bank of England, even though the labour market does remain tight by historical standards, of course. Private sector wage growth, so that's the one policymakers focus on mostly, that fell from 6.2 to 6%. But remember, since this is published as a moving average, a big base effect should add pressure in the next couple of months and push it below 6%, according to a lot of economists. So that was encouraging. And then we had the Fed's February CPI data this morning. That showed further progress across the board, headline falling 1/10 more than expected to 3.4 from 4% previously. And then the core as well falling 1/10 lower than expected to 4.5% from 5.1%. Should caveat those readings with services inflation. That is a key metric for the Bank of England and the MPC. That stayed sticky at 6.1%, in line with the Bank of England's most recent forecast and down from 6.5% previously, but was a tenth higher than the expected 6%. I think key though for UK inflation is that going forward, 2% prints are potentially expected in the months ahead, due to basically food prices falling quite sharply. They did fall in the February data. They will continue to fall potentially, as well as core goods prices falling as well. And then we have the big kicker, which is the 12% fall in household energy prices, energy bills, which is due in less than 2 weeks. And that will bring down the headline inflation quite sharply in April and May. Okay, so that sort of sets the scene for the Bank of England. If I just pull up a cable chart for us to have a look at as well, which is here. I mean, the Bank of England might not be so eventful, but of course, always interesting. The MPC expected to hold a base rate at 5.25%, but there is the potential for another three-way split between voters on the MPC. Previously, the February decision, well, that saw two officials voting for a hike and one voting for a cut, and the other remaining 6 voting for unchanged. So just watch out for that, whether there is. It's quite a rare having a three-way split, but potentially we do get another one. In terms of recent data, the MPC will, of course, have seen the inflation metrics out today, which are falling, but that services inflation is still sticky, although they'll be mindful, of course, of those energy bills dropping sharply in the months ahead. On the growth front, month on month GDP in January, that expanded by 0.2%, potentially suggesting a turning point from, of course, that shallow technical recession we saw late last year. PMI data as well, I mentioned that's due out tomorrow. But for January, it saw services slip actually, but manufacturing rise, and then the composite did tick higher. So that is slightly encouraging for the UK economy going forward. I've mentioned those wages falling as well, and then commentary sort of from the MPC has seen Governor Bailey state that, well, we don't need inflation to come back to target before we cut interest rates, whilst Chief Economist Pill, he said his baseline scenario for the timeline of rate cuts remains some distance off. So yes, no sort of major changes are expected. After the bank dropped actually its further tightening bias in February. That probably means then we'll get a repeat of rates needing to stay or remain high for a sufficiently long period of time. Pretty much those words. That's what's expected. Any difference to that, any hint about rate cuts would be seized upon and see sterling sold. We can see cable here then. We popped up to 128.94 on the 8th of May, a couple of Fridays ago. Now just falling back, consecutive days of losses, really on dollar strength. We're now back to the first fib level, minor fib level, 23.6 of this October move higher, although it did obviously stall for quite a few months. December, January, February, around that sort of range that we're now back in. We've got that at sort of 126, 128.28 with a couple of moves outside that. We've got the 50-day moving average of 126.86 as well as support, but then below that, if we do lose it, well, then we're back down to sort of low 126s with that black line offering support it has done previously, which is the 200-day moving average at 125.93. I said we just touch upon dollar Swiss as well. The S&B, they meet also on Thursday tomorrow. Not expected to announce any changes to its borrowing costs, but as I said, there was around a 30% chance of a 25 basis point rate cut. Inflation, that's the key thing in Switzerland, and that's just at 1.2%, so much lower than the S&B forecast of 1.8% for Q1, and also lower than any of their quarterly forecasts across the end 2026 horizon. It's also been actually in the 0 to 2% target band since June 2023. So really, out of all the central banks, if you think about it, the S&B kind of has the most reason to begin cutting rates imminently, and it also does have the history of surprising. Also to note, they only meet every 4 times a year, so every 3 months they meet, which yes, does bear just thinking about, we think as well, because the chances are obviously relevant, we think. It all really explains why as well the Swiss franc has been close to overtaking, was before the yen, obviously in the Bank of Japan meeting, but close to overtaking the yen as the worst performing currency this year. And if policymakers do signal a rate cut is likely at June, then, well, potentially, if we don't get a sort of knee-jerk reaction, then the franc could extend its losses. You can see it's just made fresh year-to-date highs today, interestingly, above the mid-Feb high at 88.85 and 88.92, that March high. So now we're just above 89. 200-day moving average, that black line looked like resistance, a little bit of resistance. That was at 88.20 below. So yes, after that, these swing highs, as I've mentioned, and now 89. Clear blue sky, really, you would think. and especially as that swing low from October 88-87 has been broken. Kind of looking at big figures really, unless we get up to sort of big figures, the next level for us on this, although we're getting into closer to overbought territory, so otherwise support at 88.20 dollars Swiss. But again, if they do surprise, this will shoot higher, we would think, and up towards 90 or so potentially in dollar Swiss. Okay, just got time I think to look at euro dollar very quickly. If I just firstly go to a nice matrix of the PMI data, but just before we touch upon that, generally in the Eurozone, well, we did have final February CPI figures earlier this week. They didn't surprise. And then we had a German business survey out yesterday, the ZEW. That was better than expected in March, though should say the economic situation does still remain very weak. And really suggests the German economy will likely trail behind its European peers in 2024. GDP is expected to settle in negative territory in this first quarter of the year, but obviously still have solid labour markets, recovering real incomes, and a global manufacturing cycle, of course, which is key for the German economy. That is turning slightly higher as well, so potentially then a steep recession will likely be avoided. We do get PMIs, as I mentioned, tomorrow as well. That will be a focus for euro dollar potentially into the weekend after the Fed meeting, of course. Just looking at those, you can see, yes, the sort of reddish color is denoting expansion. This is for the composite numbers across these different countries. Above 50 is obviously expansion. Below, the blue numbers are below 50, so in contraction. You can just see Eurozone still in contraction, but slightly improving, so not as dark blue, if you like, as previously seen, although Germany is still struggling. And then other areas are positive in expansion mode above 50. So yes, slight improvements expected in the Eurozone numbers across manufacturing and services, and then the composite as well expected to tick up tomorrow. So that will be interesting. We've also had a lot of ECB speakers. Christine Lagarde actually today, I'm just looking at some of the quotes from her. She only spoke not so long ago, really, yes, acknowledging the risk of waiting too long to cut rates is an issue potentially, and that kind of reinforces June as a pole position for the first rate cut. And certainly she also mentioned that the ECB will have more data, and especially wage data sort of end of April and after the April meeting. So therefore June makes sense potentially as the first rate cut, as then data will raise confidence for the start of potentially some policy easing from the ECB. We also had Vice President de Guindos actually, who said the ECB would be ready to discuss a rate cut in June. So again, reinforcing that data course, given that sufficient data would be available by then. Though he actually did note that rapid wage growth and poor productivity might pose challenges to the schedule. Okay, we'll just wrap it up with a look at dollar yen, not dollar yen, sorry, euro dollar, which is here, sort of the reverse, if you like, of the DXY chart that we showed you, which has by far the biggest weighting being the euro, around 56-57% or so of the dollar index. Do not forget that. Okay, euro dollar though, yes, so just coming off that recent high, the March high at 109.81, and we're now just resting on the 200-day moving average. Really interesting, that, and the 50-day moving average around 108.38 and 108.42. So if these give way, then we've got the halfway point of this Q4 rally at 107.93, which was previous support at the start of March. Okay, we will finish there then. a lot of risk events to come, even after, of course, quite a lot of risk events already. We will look at these events, of course, in a couple of weeks' time when we have the next webinar. Take care out there, and we will speak to you soon.